Okay, got some folks. Welcome, everybody. Good to have you all here. Kim, Kelly, good to see you all. All right, well, I think 10:40, we're about time to kick off here. So welcome back. Today we have, of course, the release of the second quarter 2023 Michigan Future Business Index, or our MFBI. Used to call this originally the FBI, Future Business Index, but we didn't get the response we expected, and people were a little critical of that, so we changed it. The survey's been conducted in one form or another since the year 2003, so we've got a lot of great trending going on, those types of things. The MBN Speaker Series, which this is a part of, has been going on since 2004, and when COVID hit, we transformed form to our speakers series going virtual. And as a result, when we returned to live events in our mix, we found a couple that we could still do this way because it was information and presenters that we wanted to get out to the business community. And I would remind you, our audience today is from across both peninsulas. And this will be viewed live with us at this time, and is also being recorded, because the audience, this is a small reflection of the audience. The audience actually pulls this off of podcast at their leisure within the next few days. So the audience is much bigger than what we get here, not dissimilar or larger than the normal audience that we have when we have a speaker in person. So something to keep in mind. Let me remind everybody that these events don't happen without our sponsors. And so we're very happy to say thank you to LAFCU, represented here today, Dean Transportation, Foster Swift PC, I know, I saw Kim there too as well, AP Laser, Shaheen Chevrolet Cadillac. We also have PNC Bank, who is a sponsor today, the Capital Region International Airport, Fly Lansing, BCI, the Business Community Institute at Lansing Community College. Raise your hand. Raise your hand. There you go. All right, good. Michigan Future Business Index does not happen, of course, without Cinnaire, who has underwritten the entire series, the Michigan Business Network, and of course, ROI Insight. And somewhere on here is Paul King, who is the owner and has done this for us. There you go. There's a little wave. He's done this for the vast majority of the years that we've had it. And we've actually moved with Paul personally through two employers, and now to ROI Insight, which is his own company. So we're glad to see that go through the ages, so to speak. Now, our presentation today is pretty hot off the press. The Michigan Future Business Index is going to be delivered by a representative from Cinnaire at the top of the hour. All right, good enough. So let me get on with this program then. Let me call on Josh Ghena. He's Senior Vice President of Equity Funding at Cinnaire. Great partner of ours. He's going to be filling in for Cinnaire's President and CEO, Mark McDaniel. Josh joined Cinnaire in 2014, serves as a Senior Vice President, Equity Business Funding. He is charged with the management of Cinnaire's investment strategies, oversight of their equity funds, investor due diligence, and fund modeling. He's held positions of increasing responsibility at Cinnaire over the years, and in each of his roles, he's helped refine the asset management process and has developed tools that allow for more efficient and effective portfolio analysis. So prior to joining Cinnaire, Josh provided technical assistance to distressed HUD grantees. His work as a technical assistance provider specialized in CDBG, HOME, H-O-M-E, and NSP. So with that, after getting his degree at Calvin College and his MS from the University of Wisconsin, Josh, I'm going to turn it over to you, Josh Ghena.
Thanks very much, Chris. So it's a pleasure to be here today. I'm excited to share this report with you all. I'm pinch hitting from Mark McDaniel. I'm going to do my best to be better than Spencer Torkelson and actually connect on some opportunities. I think the last 2 days with versus the A's have really kind of scarred me. But I'm a native of Michigan, grew up in Metro Detroit, migrated to Grand Rapids, go to school, left for a little bit across the lake to go to Wisconsin. Came back, commuted to Lansing for several years. Now I'm working out of Grand Rapids, have family from Houghton Hancock. So Michigan from all the way north, all the way south, east to west, and very passionate about the state of Michigan and what we're doing here. So Chris mentioned at Cinnaire, Cinnaire is celebrating 30 years this year. As a CDFI, so Community Development Finance Institution. We're doing debt and equity work with communities throughout the Great Lakes and Mid-Atlantic, really committed to serving the people who live in the communities that we call home. And so, we will be able to share some insight from what we're hearing from our partners, which are largely from the banking sector, insurance sector, construction, real estate, as well to supplement what you're hearing from Paul's research. And so as we get into the actual slides here, you'll see, an outstanding response from you all, over 600 completed surveys, and so it's a great sample size, as Chris indicated, statewide from the Upper Peninsula all the way down to Monroe and across. So a lot of really good information here. So if we go to the next slide and start looking at the results of the survey, I would say as we go through this, the takeaways here are kind of a mixed bag. We're going to see things that are positive, areas where people have a lot of optimism, but we're also going to see the emergence of the concerns about the economy showing up for the first time in the survey. And I think that lines up with what we've all experienced over the last 6 months. When you compare where we were at in November to where we're at today in June, we're moving from COVID into dealing with inflation, wage growth, and now general concerns about the economic condition. And so despite those concerns, folks remain to have a positive outlook over the next 6 months. That's countered by seeing sales and profits both saw a decline to the number of people reporting an increase for the last 6 months. So there's more people in the hold steady category than there are in the increase category. And so that lines up again with this larger concept of emerging concerns about the economy and how the last 6 months have gone for everyone. The flip side of that is when we look at projections for the next 6 months, people are projecting to hold steady or to grow profit. And within that, we're continuing to see positions, staffing remain consistent, not a huge change in terms of people reporting layoffs. People are holding staff and looking to continue to grow staff. And the ending part of this is that most people are feeling that they're recovered from COVID. There is still a segment of our economy which is not recovered yet, and a slice of the economy and business sector that is concerned that they won't recover from COVID. But when we get into the details, you'll even see within that number, the number of individuals reporting that they aren't going to recover has declined over the last 6 months. So it's a really good snapshot here from Paul in terms of what we're seeing across the state. Emerging concerns, but that's being buttressed by continued positivity. And with that, let's get into more of the details. All right. So this is where, you'll begin to see the numbers around what we're talking about. And I would say one of the headlines here is around wage increases. It's looking like we might have hit a crest in terms of wage growth, at least from what is being reported. So wages have certainly continued to increase over the last 6 months, but they're beginning to stabilize. We're not seeing that continued spike. And so that's a positive. Now, they continue to kind of remain high. And I would tell you from our perspective at Cinnaire, if I think about inflation a little bit more broadly than wage only, we're seeing inflation be fairly sticky in terms of cost increases on construction, on the real estate sector, materials. And as long as that inflation remains sticky and is not dropping, that's going to have continued effects on the economy. And, as we get into more detail here, one of the things that stood out to me is there is a split in the survey response between sector, and those in the finance and real estate sector are a little bit more pessimistic about the outlook than folks in the other side of the sector, within manufacturing, within retail, within food service. So as we've come out of COVID and there's a lot more activity of general activity in the economy. Those sectors are seeing a lot of positive upticks. But for those of us that are heavily reliant on interest rates and where that business sector is being affected by supply chain issues and increased costs, like there's not as much positivity. There's a little bit more pessimism in terms of the outlook. And so there's, a little bit of a dual experience here within the marketplace. And so when we look at the performance of the business sectors over the last 6 months, we're seeing that a majority of people are suggesting that sales and profits are remaining constant, right? But what we're not seeing is the same level of folks experiencing growth. And, in that line here of profit increases hit a record low. Only 19%, so only 2 in 10 of respondents saw an increase to their profits over the last 6 months, and that's a low for this survey. So hiring has remained steady, and layoffs have not increased. And then there's a slight drop in the capital investments people are making within their businesses. So again, this moderation of the economic conditions of not terrible things, not great things, things that are positive and good, kind of happening simultaneously. And so, we're having a kind of a mixed experience here within the market over the last 6 months. So let's move on to the next slide. So this is where we are in a more positive position. People are suggesting that there's a growing sense of satisfaction with the economic conditions in the state of Michigan. And we're down from previous survey where 55% of respondents were dissatisfied to now 50%, right? So we're split down the middle here in terms of half are satisfied with the condition and half feeling somewhat to very dissatisfied. And so I thought Paul's note here around intensity is really important, right? In terms of the experience that we're having, and that experience is not uniform. And so for those that are dissatisfied, like there's a strong degree of intensity with that sense of dissatisfaction. And you're seeing here again where the people who are most likely to be satisfied with the economic conditions are going to be in the retail sector, the professional services sector, and those who are facing headwinds are really going to be in the finance and real estate sector, as well as healthcare and nonprofit. And again, I would say from Cinnaire's perspective, we firmly sit in that insurance, finance, real estate bucket. And I would say that our sense of the next 6 months is more cautious than strongly optimistic, but our sector is heavily affected by what's happening in the interest rate environment, what's happening with construction lending, and as it's more difficult to build buildings, and as interest rate needs continue to rise, and everything that's happened over the last, hard to believe, but only like 4 months since March with the banking sector, and continued changes to regulation or expected changes to regulation amongst banks around capitalization requirements, tightening of credit, in terms of credit policies. We're just seeing a slowdown within that kind of real estate and finance sector. So this definitely lines up with, our experience, here at Cinnaire. And let's move to the next one. So this gives us a great snapshot over time of seeing, almost a 20-year run here, 15-year run or so of satisfaction with our local economic conditions. And, go back to 2006 and through 2008, the height of the Great Recession. And this is when I was doing distressed HUD grantee work, because the amount of foreclosures, right? And we think about, that work was all around working with states that were dealing with massive increases in single family foreclosures, and how states were dealing with that was a big part of where I started my career. And as conditions improved and we saw that boom over the last decade, you'll see that sense of satisfaction peaking right around 2019, and then COVID, pushed everything off a cliff. And so, you'll see the survey tracking closely with, I'm sure, all of our shared experiences over the last 15 years or so, and when I kind of look at this through my lens, I see a period of extremely low interest rates through that heightened period, right? And that sense of satisfaction and that climbing positivity. And I overlay that with, the cost of funds. Like those things are all kind of moving together, right? As cost of funds have dropped, lending becomes easier, the access to capital is more flush. People's experience is more positive. And as we have kind of recovered from COVID, right now we're in a place where, the market is trying to figure itself out. the Fed continues to raise rates. Banks are trying to find their footing after a couple incidents in March with issues with liquidity. And the story that will come after this is yet to be told. But right now we're at this place of coming out of COVID and trying to figure out what's going to happen next with our economic conditions as we adjust to a new sense of what it means to operate in business where capital has a much higher cost than it has for the last decade. Really liked these series of charts from Paul. Gave a great view of people's concerns and future perspectives. What's telling to me here is really you're seeing the top three remain consistent. So the challenges to doing business remain inflation, talent acquisition, and wage inflation. But those all have gone down from where they were 6 months ago. Those really peaked 12 months ago in June of last year and have continued to make gains. But we've seen this emergence of economy weakening. Now it's just outside of the top three at 25% of the respondents are seeing that as the greatest challenge to doing business, right? And so that's, I think, a marker that's important to take note of. And I would suggest is probably wrapped up in those top three, right? Issues of inflation and labor and the cost of labor. That is a recipe for trying to figure out how to operate in a new economy. And right now that's a challenge and we're still figuring that out. And things that are happening now with unemployment and inflation, they are breaking. I'm not an economist by any stretch of the imagination. I was a political science and religion student at Calvin and an urban planner. So, take this with a grain of salt. But things that are happening in the labor market right now with rates, like they're not operating in the way that people have expected. And so it's really uncertain of where things are going. And I think that's reflected here in the survey results. We are seeing improvement here in talent retention, and we are seeing that to be less of a problem, seeing a decrease there. Supply chain issues are improving, which has taken significant strides over the past 12 months, which is excellent. I would say in the construction sector, we are still seeing key supply chain issues. It's not everything, like where before you were having problems with lumber. Now it is very specific elements like electrical panels. Like sometimes we're having 12-month lead time on very specific electrical parts. And so supply shops, construction companies are having to really proactively manage their inventory and really stay organized to be successful. And you're seeing some separation from those companies that are very good at managing it and companies who are not. And there's a very different kind of end user experience as the shops who are able to separate and really manage that process well, there's a much higher sense of customer satisfaction. So I would say amongst the construction sector, we are still seeing some issues with supply chain, but nothing to the scope and scale that we saw 12 to 18 months ago. All right, let's move on to the next one. So let's take a look at the reasons for optimism. And so we're seeing an increase here in hope for reform amongst the political space. Given the last 6 months and having navigated the debt ceiling, I have to imagine the outcome there is being reflected in the survey results and the fact that we were able to navigate that as a country and find a solution which led to us not defaulting, gave a lot of reason for optimism because I think there was probably a good deal of pessimism around that when we looked at where we stood coming into the year and the outcome there. I think you're seeing those results here in the survey. And so otherwise, not a ton of change, some small changes, but more than anything, a lot of consistency amongst where folks are seeing their opportunities. Let's move to the next slide. So this is tracking emerging from COVID. And so what we're seeing here is there's a segment that is still just okay. That's remained pretty consistent here for the last 6 to 12 months. But we are seeing an uptick in those who are feeling they are recovering, right? So when we look back over the last 12 months, that's a large gain in the number of folks who are feeling recovered. And what's, I think, telling here is that you're seeing a migration from those not doing well to those that are doing pretty good. And so whether that is a bump from not doing good to just okay, and those in just okay now doing pretty good, generally you're seeing an up migration of experience, right? So the bottom line here of not doing good is declining while you're seeing gains in the pretty good, which is a really strong result. And I think tells a really positive story for us as we're emerging from what was an extremely challenging 3-year period. And so this breaks that down in a little bit more detail. And what I would really call attention to here is that I'm not sure the sector here of 15% in turquoise, I'm not sure my business will ever fully recover. At 15%, that struck me as still a fairly large segment of the survey community. But Paul's note here is that is down 6 points from a year ago. So I think that tells a very optimistic story, and is something that is really important to grab, is that although there is still a segment that feels that they will not recover, the number of folks in that space has declined. And you're seeing this improvement, and now over half of folks are feeling like they are fully recovered. And that jumps almost another 10 points by people who feel they'll be fully recovered by the end of this year. And there's still a quarter of the segment that feels they will take yet another year to recover, but we're somewhere between 50 and 60% of the survey respondents feeling they are fully recovered or almost fully recovered. So this gets into more detail on what we covered to start with, is what we are seeing. The projected sales growth is up. And so when we're looking at not what has happened over the last 6 months, but where the survey respondents are seeing the next 6 months, I think it's telling that you're seeing people suggesting that their expectations are going up. And so the number of folks who are expecting sales to decrease over the next 6 months dropped from 17% to 11%. And that tells a very positive story of how the survey respondents are feeling about the next 6 months. So despite this emergence of a weakening economy showing up on people's radar, I think it's very telling that they're not necessarily tying that to their performance over the next 6 months. And so I think that tells a very good story in terms of where people are at today. And despite the headwinds and challenges that they see coming, they have expectations that they will continue to hold steady or increase their business over the next 6 months. And again, you're seeing the split experience. These last two bullet points here are telling, and where those expectations are being set, right? So expectations for growth are highest in retail food, lowest in healthcare, and those increases in profit are, again, retail food, and lowest in finance, insurance, and real estate. And again, that aligns with our experience, and you're seeing, a continued strain on that real estate sector. But as people have recovered from COVID, a real, positive outlook for those in the retail and food service sector. So when we're looking at current staff levels, a majority of respondents are suggesting that they're going to maintain staffing, and about 4 in 10 are saying that they're going to add more staff. So that's the lowest hiring projections since before COVID. And so this is the third consecutive index that has indicated that there will be a hiring slowdown. And so we're seeing a majority of respondents suggesting they are holding current staff levels instead of increasing staff levels, but only 5% suggesting they have a plan to lay off back to 2021 levels. And so I will be very curious to track this number over the next several quarters and over the next several index cycles as we continue to sort through the changing economic conditions. And, but this matches what's happening in the larger labor market in terms of unemployment numbers. Unemployment still remains extremely low. And this is supported here by, almost 90% of respondents saying they're keeping staffing levels or they're going to increase staffing levels. Let's move on to the next slide here as we begin to come to a conclusion here within on our survey work. So still challenges in talent acquisition. I will tell you this is certainly our experience at Cinnaire in terms of how hard we have to work to bring good people onto our staff, and then really focusing on retention being a kind of a core element of where we have focused our time to make sure that we're able to hold our team together as we work very hard to fill it with very qualified individuals. And so you still have about 60% of respondents having difficulties filling opening jobs. However, this is down from last year. So we're seeing gains there, and not as many people are having challenges, but still 6 in 10 are having trouble filling open jobs, which again speaks to and matches the overall labor market when we're seeing unemployment remain at historic lows. So a little bit more on the specifics of wage inflation. So as we spoke to earlier, we're seeing wage inflation as a challenge in our sector, right? It's still the third highest reason of concern. However, we're down over the last 6 months in terms of respondents suggesting they have to continue raising wages as a way of dealing with open positions. And so now we're still at 4 in 10, slightly less than 4 in 10 respondents saying that they will raise wages over the next 6 months, but again, down from where we were back in November. But a majority are saying they are not going to raise wages, but we're not seeing a reduction in wages. So wages have gone through a significant spike, and a clear majority of respondents are saying that they expect those wage gains to remain in place for the foreseeable future. And again, you're seeing those wage growth are strongly located within the healthcare sector as well as manufacturing, construction, which lines up with our experience here at Cinnaire. So when we look at what's happening with investments in businesses, we have a majority of people focusing on investing in their employees over the next 6 months. And this is up 2 points from last year, but down 6 from November. So think of this as somewhat of a roller coaster number over the 12-month period, with it peaking about 6 months ago, but still with a majority of respondents focusing on employee training over the next 6 months. And that lines up, I believe, and makes perfect sense when we think about the focus on employee retention and building and maintaining the staffs that we have within our respective businesses. You have about half of respondents investing in advertising, which is slightly up from a year ago, and only a quarter plan to invest in new equipment, and that's slightly up from a year ago. So I would say I read this as being status quo. We have not seen significant change in either advertising or new equipment, and those remain consistent among survey respondents. And a big note here is around a third of respondents plan to expand their business with a new product or service line over the coming 6 months. And that's up 5 points from a year ago. So when we look at that recovery from COVID, we look at that kind of split experience of some folks feeling very satisfied with economic conditions and others having challenges. There's a third of the respondents that are in their optimism over the next 6 months are looking at expansion opportunities, which is up from prior year. So bringing this all together across the state, people are having an increased sense of satisfaction with the economy. We're seeing fewer people be dissatisfied, which is a great thing. People are still worried about inflation. It is still our top concern. However, it is not growing, it is beginning to soften. And so although it is still the number one thing keeping us awake at night, it is no longer continuing to rise. It is starting to taper. And wage inflation appears that it is coming close to a peak. And that although sales and profits declined over the last 6 months, people are optimistic about the next 6 months. And again, this gets to this kind of split experience. And despite some of the headwinds and challenges, folks in our business community remain very optimistic about what the next 6 months are looking like. And although we are seeing a pullback on hiring, people are focused on retention and support of their existing teams. We're not seeing a decline in hiring, right? And we're seeing all the hiring that has really taken place over the last 12 months, that businesses are really looking to focus on onboarding and retention of that new staff to build out their teams, which makes perfect sense when you think about the ramp up of hiring that we have all gone through over the prior 12-month period. Finally, things from the pandemic are beginning to come full circle. We have a majority of businesses that are feeling fully recovered. The number of businesses who feel like they will never recover continues to decline. Which tell a tremendous story about our resiliency within the state of Michigan, and things continuing to recover. And supply chain issues are becoming less significant, although they are still prevalent. And so really, my takeaway, having gone through this over the last, several days, is one of optimism with some sense of moderation, right? Which I think is a reasonable outcome given everything that's going on around us. There are a lot of things to be excited about, but they're not without their areas of concern. And there are elements that we need to be fully in tune with and stay close to within the market. And I speak from those, working specifically in the banking sector, but there's a sense of long-term positivity. I would tell you at Cinnaire, even if we're a little bearish over the next 6 to 12 months, we're still very bullish over the long term. We have a lot of belief in the Great Lakes, upper Midwest economy. We feel very good about another 30 years of doing business. And so long term, we are very positive, and we expect to ride out the next 6 to 12 months with, continuing kind of waves of bumpiness, but being prepared for that and being resilient and continuing to really contribute to the regional economy. And we remain very positive about our work here in the state of Michigan.
Well, Josh Ghena, thanks so much for that presentation. That's great information to go forward. And the intent of this is always to help all of us make better decisions about the next 6 months. In many cases, and especially in the small business sector, you find that predictions and the way you feel about the future is a self-fulfilling prophecy. So if you feel good about what's going on, it's much more likely that good things will happen in the future. So thanks for that. And this information that Josh just presented can be found this afternoon on the MBN website, MichiganBusinessNetwork.com, and Cinnaire's website as well. And then it'll be sent out to share as well. So please watch for all that to come down. Are there any questions? One of the questions I had, and I don't know if Bob is still on the call, but he might be able to answer this as well, is when you talk about the 26% of people being challenged still with the numbers of folks here, the talent, is that the case in Michigan only? Because this is a Michigan only survey, but I know that Bob Trezise is out there competing against other states. And Bob, are you, because what I'm kind of finding anecdotally is that there aren't many states that aren't in this same circumstance.
I don't know the total answer to that right now, Chris. Anecdotally, we are competing, have a number of very large, unusually huge projects, looking at a variety of sites in our community. They are attracted to our region because we seem to be able to answer the labor question in an interesting way. They like that about Michigan and our region, and that we can supply that kind of labor force. But of course, a lot of it is super high tech now. So they also love the Michigan State University and LCC component to that labor force that we can provide. So we have a really unique kind of two-tier in the Lansing region, a way of answering the labor question. Our struggle is, well, to be blunt about it here, is that Michigan's population growth continues to be pretty much for the last 20 years and currently the worst in the United States. And it's very disturbing. In addition to that, our population, more than other states, is growing older and becoming older and less young. So these are really, really troubling, disturbing trends. Placemaking and good jobs are the answer to that question, I think. So to conclude, the coasts and southern states, especially southern states that continue to have very, very robust population growth. For instance, the city of Denver adds 300 new people every single day. And, that is a wake-up call. Nashville's, Columbus's, these kind of great cities, and especially great cities in more southern tier states, have such continued population growth that they are able to be extra attractive to companies, and is difficult for us to compete with.
Before we move on from here, Paul King, every time we do this every 6 months, we give away a couple of prizes for those of you who respond. And like Paul pointed out, and like Josh pointed out, we've had an overwhelming response the last couple of times out. And so we throw them into a hat and we pull out a couple of winners. Paul is always the keeper of the hat and the announcer of those he's pulling out. So what'd you find in your hat, Paul?
Just a rabbit.
Are you still doing that?
Very thankful for all of our respondents and for all of our small business owners out there that are very willing to provide their experiences and opinions about what's going on in the state. For, as long as we've been doing this, it's been very helpful to help us keep our finger on the pulse, as they say, to understand what's going on out there. So the winners, I drew them this morning, fully randomly, just like Chuck Woolery. And the one first winner we have is Max Gibbard, owner of Team Logic IT out of Grand Rapids. And Martin Carter, president and CEO of Astura Credit Union in Lansing.
There you go. And what are the two prizes?
We have the flight out of Lansing Airport. We have a voucher for that. And then we have a voucher for golfing package at the Majestic Golf Course.
I just wanted to hear the Majestic voice.
I know you did.
Okay. Well, congratulations to those winners, and thank you, everybody who responded. And thanks, Paul. So to give an even bigger and fuller picture of what's happening across Michigan in the business sector, to hear from several leaders in our region, each on both what they've seen and experienced so far this year and what they anticipate the rest of the year of 2023. So let's start right here at home. Julie Pingston, Greater Lansing Convention Visitors Bureau. Let's talk about 23 so far.
All right. Well, thank you, Chris. If you're not familiar with the Convention and Visitors Bureau, we promote this and market this region for tourism. And so we represent the tourism and hospitality sector. We had a really rough last year, first quarter. So this year's first quarter was leaps and bounds better. We finally had people coming back to meetings and events. We had a lot more new events taking place. So in comparison, year to date, so it's not a leaps and bounds growth. We have, as an industry, been slow and steady for the last 3 years. And right now we're catching up with many other destinations, and last month leading most destinations in the States for hotel occupancy. So we're getting there. Obviously, before the pandemic, we were doing much better. We were in the low 60% of hotel occupancy, but a ways to go. But we also had 2 hotels open during that period of time, so a lot more rooms to sell. But that is some of the excitement looking forward, is that in mid-August, so a month-ish from now, we'll have 300 more guest rooms opening in this community. A Hyatt House and AC by Marriott opening in part of the Red Cedar project. So those are going to bring about 300 additional rooms to the community. They also have a signature restaurant going in called Toscana. And all told, that's going to bring about 200 jobs just in that little corridor right there for the tourism and hospitality industry. We just finished a very significant event called Odyssey of the Mind, which brings over 8,000 to 10,000 competitors to campus. They're all youth and very creative. And so they're from around the world and especially from around the country. So it was great to have that event back. And Scott Keith here on the call has turned into a sports venue for the month of July. He's got the National Horseshoe Pitchers World Championships coming in mid-July. And right now moving in is a large youth amateur wrestling event. So that's a really good sign that those type of events are coming back. The industry also has a lot of fun new businesses coming, which we haven't seen in a bit. Graywall Hall at 224, entertainment venue, is going to open on July 15th with the Verve Pipe. Maybe some of us remember them from back in the day. So that's opening on Washington Square. Bobcat Bonnie's in the old Clara station is opening sometime in August-ish, is what they're saying. So they've renovated that facility. It looks really fantastic. They put outdoor patio, a private dining area. It's going to be a really great addition. And then we also have the Lansing Shuffle right along the riverfront, adding their shuffleboard courts. So 5 courts for league play and your fun shuffleboarding adventure. So we've looked at the year of slow growth and really anticipate with students coming back to campus, a record class of incoming students, that the rest of the year will stay strong and stay solid for us. And we should finish well ahead of last year is our expectation. So slow but steady wins the race for us, and we're happy to be continuing moving forward.
Great report. Let me ask you about that slow and steady though, because when you were up 3 points in occupancy, at the same time you were adding more room nights or more rooms. So it may be slow and steady, but you're selling a whole lot more rooms.
Yes. So at the end of last year, we crossed back over the sale of 1 million rooms. So that's kind of our benchmark, and we're ahead of last year's pace with that total rooms sold already.
Okay. Just want credit where credit was due.
Yeah. Well, yeah. And we got 300 more every night for the coming on board in a month. So
Whoa.
we're working hard over here.
I can't wait for a Q4 report. Tim Daman, give us an update on the Lansing region here.
Well, Thank you, Chris. Appreciate the opportunity to be here this morning. And we track and follow a lot of the U.S. Chamber. They do quarterly national surveys, and they break it up into 4 quadrants nationally. But the data that was presented here this morning aligns very closely with the second quarter data that just came from that report, last week as well. So I just wanted to kind of pass that on. I think we're kind of seeing what we're seeing here is a snapshot in our state as well. I think you're seeing similar numbers nationally. So, you know what, being a chamber in the state capitol, it's always easy and probably to lead with some of the state policy activities. And I think we get associated and lumped into a lot of things that happen at the state capitol, and I'll leave that up to everyone else on the call here to think if that's a positive or a negative for our region. But you know what, we saw the Dems take control back in January with a pretty bold and I think aggressive agenda that they had successfully ran on last November, and they came in and that was repealing right to work. They were able to do that in the first half up here. The Elliott-Larsen expansion, of which we were pleased as an organization, as a number of chambers across the state, to support what they were doing with the Elliott-Larsen expansion. That was really some protections for the LGBTQ, as well as the recently added the Crown Act, which our own Senator Sarah Anthony introduced that legislation, and really anti-discrimination against hairstyle. And we were pleased to support both of those. There was some tax policy that they had wanted to do, and they were able to get through, and that was restoring the earned income tax credit. Again, something that our organization, a number of business groups around the state supported and thought that was critically important. And then repealing the retiree pension tax. They're building upon the ballot proposal 3 last year and the success with that. And then the governor and legislator repealing the 1931 law that banned abortions in our state. So again, kind of their top priorities in their agenda, and able to get a lot of that through. And then really leading up until last week, and with the state budget, the $81 billion budget that was approved, and it was very significant for our region. We had over $200 million in dollars flowing into our region, and really what a great opportunity for downtown Lansing. I know a number of our partners on the call here with Julie, Bob, and Scott, and I may be missing some other folks. If I do, my apologies. I know Kelli was, I think, part of that as well, but really supporting what we were looking for out of the state budget. And I really think it's probably the greatest investment we've seen coming through in appropriations, the state budget. And so a really good opportunity for our region, but I think specifically for downtown. Julie mentioned the ovation, the groundbreaking with that last week. Dollars coming in, $40 million potentially for the redevelopment of a city hall. And so some key pieces and dominoes that we think can kind of move and maybe generate some new excitement for some additional private sector investment in downtown. So I think looking at that, downtown first half of the year, I think was a continued struggle. But again, I think there are signs that are increasing. There was language in the state budget that talked about prioritizing in-person work. And so we're hoping that we'll continue to see a little bit more folks coming back to the office in downtown here, and certainly helping with our small businesses. We are watching a few bills this fall that probably will be back on the agenda. They're being categorized, and they're not called this, but really kind of anti-employer bills. And I saw in the data report that the government regulations piece was up 7% from the year-end survey data from last year. So that's something we're keeping an eye on, as well. Our region continues to see significant infrastructure investment, $800 million planned between 2022 and 2028. I'm a broken record on that. I know a number of you hear me talk about it all the time, but it's so significant. I get it. It's difficult. I get as frustrated as everybody driving through it and not being able to get anywhere in our region, but it is so critically needed to continue to support our economic growth and investment here. But $800 million, and I would probably say in our roads and bridges, it's much needed, but probably historic investments as well. Thinking about healthcare, and just really quickly, with the Sparrow and U of M medicine affiliation was big news for our region the first half of this year. And I think when you kind of look at where McLaren is, and the $600 million investment, 2 strong healthcare systems in our region, 2 global research universities, both with high quality med schools. I mean, certainly we feel bodes well for the region. At the same time, I think healthcare nationally continues to see a lot of economic pressures. And I think you hear folks will say that it's a looming and pending crisis. And so I think kind of keeping an eye on what healthcare looks like moving forward. The small business piece, I think it aligns very closely and clearly with everything you said in there. We continue to see optimism remaining high. Caution, yes, but I think when you kind of look at, the jobs and economy, that's where the inflation falls in, the workforce falls in. But you know what? Businesses are innovative. They're resilient. They're finding new ways to adapt and to grow and get around some of the workforce challenges. I believe the ancillary items, the housing, the childcare, the public safety continue to kind of be some other issues as well. And then I think the last half of this year into next year, you're going to begin to see the 7th congressional seat. And that was something I talked about earlier this year as well. And it looks like it's going to be Tom Barrett, Curtis Hertel Jr. Race. It will be one of the top races in the country again. I think there was like 20 million spent in that Barrett Slotkin race in 2022. You'll probably see very similar, if not more dollars, into this race as well in 24. And I think it will, have a big impact on, what the congressional makeup looks like, in the presidential election next year going to 2025. So, but thanks again, Chris. Appreciate the opportunity to kind of give a little update here.
Well, I've got you. Any predictions on the elections?
Any predictions on the elections? Yeah, we could have a whole show on that, couldn't we? So.
I didn't mean to do that to you. I'm sorry. Okay, good. Hey, Josh, I want to come back to you just for a second because a lot of what you see in this report is kind of a reflection of your own company and what they're confronting. Tell me about interest rates and how that is affecting things, because interest rates is the elephant in the room in my mind.
Yeah, great question, Chris. So, in the real estate sector, we're very interest rate sensitive, right? Both from like long-term debt in terms of, what the property can support, but also, very construction interest rate sensitive. And so in that short-term kind of construction lending, as rates have gone up significantly, the cost of projects has gone up, right? So you have this kind of supply chain inflation costs. So building anything is just more expensive. Hiring staff the cost to a contractor is more expensive because of wage inflation. The materials to buy are more expensive because of inflation. And now interest rates are higher. So the cost to borrow to build is more expensive. And so everything is more expensive, which means it's harder to make projects pencil out. And so that's a question of like what I'll call like deal viability, right? So when we're tracking interest rates and looking at movement with the federal rate of funds, where banks are borrowing money at, and then that's passed on to borrowers in terms of the spread. And then you're also now seeing banks needing to increase their deposit returns, right? And so like you have this dueling issue of interest rates also affecting like the cost to borrowers and the end users, which affects like our space in terms of your ability to build and get projects in the ground and completed. But also now on the banking side, like where banks are at in terms of how they're keeping their money. What are they doing with their liquidity? What's the OCC Tim rightly brought up the regulations question, right? Which definitely was a growing reason of concern. And, and on the banking side, I just know that there's more regulation coming. Whether it's good or bad, I think is yet to be determined, but I think it's very clear that all the regulators have come out. I know the Michigan Bankers Association hosted their annual conference, several weeks ago on Mackinac. And, what we're hearing from the FDIC, what we're hearing from the OCC is prepare for more regulations. Now that will vary based on bank size, but ultimately, what that means is if banks have to hold more cash and they're having to give more to their depositors, right, in terms of return, what they're going to be lending at is going to continue to rise, right? And so we're expecting the Fed to continue to keep rates higher as inflation remains sticky. And we're expecting banks to having to continue to increase their interest rates to make sense of their deposits. And so what that means for the real estate sector is we're prepared for like looking at continued cost increases and fewer projects making sense. When money was free and projects penciled out at like 3%, and if now interest rates are 6 to 7 to 8%, not as many projects make sense in that space. And so, to us, that's a major focus right now, and understanding what's happening across our landscape and how rates are affecting the viability of future commercial real estate products.
Well, Josh, it's interesting because one of the regulations you're going to see, and I hesitate to call it regulation anymore. I like to call it over-regulation. It's kind of knee-jerk reaction, but you're going to see they're going to make banks hold more in liquidity. And that means it's not on the street. And
That's right.
that slows things up. I think you guys might be driven more back in the future to private funding. Which is your origin, your return to the womb, so to speak, but yeah, you're right. When you can't make it cost effective, it's not good. So Kelli, what regulation wise, you guys may be the salvation because you're not regulated in the same way that banks are. So tell me what is happening right now with interest rates in your sector. And is there regulation that will be affecting you and keeping you from taking more commercial?
So Josh is right on point, and it does what he says is relatable to credit union space as well. So cost of everything is up, rates are up on both the deposit and loan side. Still, we have ended up in our mortgage space creating a 10-6 arm earlier this year or late last year, maybe it was late last year, where the rate stays fixed for 10 years. And then we'll begin to adjust every 6 months. It can adjust every 6 months after that, with 1.25% off the approved 30-year fixed rate. So it was a product that to address that rising rate market, and to help people still afford to get into homes. But yeah, so regulation, I think in our space, the regulation that we know is coming is on overdraft protection or overdraft tolerance. A lot of places call it different, ODP fees. But fintechs, they're regulated the least, if at all.
Yeah. And
they look like nowadays a bank or credit union or mortgage company, depending on what your flavor is, what your need is. SoFi is a good example. Josh may know that may be something Josh has a little bit more pulse on.
Well, I just have a feeling they're a little more risky when you look at that sort of thing. But the irony is that one of the things we need most is affordable housing, and you can't make a business case for it, and that's stopping us in our tracks. So that's something we've really got to deal with. So great reports from everybody. Thank you so much. If there's no more questions, we're going to thank again our sponsors who are very important and very near to our heart. LAFCU, of course. Thank you, Kelli. Foster Swift. Thank you, Kim Hafley. AP Laser, Tong and Dylan Lee, Shaheen Chevrolet Cadillac. Jason, thank you. And thanks to Ralph, PNC Bank, Tim Salisbury, and Capital Region International Airport, of course, Nicole Noel Williams. The BCI, the Business and Community Institute at Lansing Community College. Thank you to Bo. And we want to thank all of those for making all of this actually possible. Again, the Michigan Future Business Index doesn't happen without Cinnaire, especially Josh. Thank you so much, Josh Ghena, our presenter of the day, Michigan Business Network, and ROI Insight. Our next event, September 13, 11 a.m. Location is pending. Our speakers for that are going to be a mobility panel that will be highlighted by Mish Auto's Glenn Stevens Jr. Glenn knows as much about what's happening in the automotive industry, and certainly in autonomous vehicles, electric vehicles, et cetera, as anyone. He's the vice president for automotive and mobility initiatives as well. So I want to thank our MBN team for their assistance today. Sarah Mosier, Michelle Lee, Benjamin Robinson, Jeff Mosier, and of course, our old friend Wade, who is now back from China and able to help us. Finally, I want to thank all of you for being part of this. and all of those future viewers, part of this 23 virtual speaker series event. If you want to go back and watch what's happened today, it's on the MichiganBusinessNetwork.com. All that can be re-grabbed. And by the way, have you been checking out MBN podcasts on Spotify, iHeartRadio, as well as iTunes, Google Play, SoundCloud, many others that have podcast platforms? These additional platforms are allowing us to expand even further the size and the geographic scope of our MBN audience. So with all of that in mind, is Bob Trezise stay on? Is he still on? Nope, had to go. Okay. With all of that in mind, until next time, great to see everybody, even on the screen. I look forward to seeing you in person even more. And all of you have a very prosperous month. Thank you.